in Edinburgh to launch one of the most ambitious packages of financial service reforms that we've had for decades.
What we're looking at here are 13 documents, hundreds of pages of reforms, and the promise of sweeping deregulation of the UK finance sector. I mean, what could possibly go wrong? They're called the Edinburgh Reforms. And today, we're going to cover some of the key points in plain English so you can make up your own mind if all of this is a good idea. Let's start with, why is this happening? Hate it or love it, the finance sector is a big deal in this country. And a lot of that has to do with a similar set of circumstances to the ones we face today, but from the 80s. In 1986, when Margaret Thatcher deregulated the finance sector. It's hard to describe just how monumental this was for finance and ultimately the economy of the UK. Before 1986, banking and finance was like, the banking manager knew everyone in the town by name. I even found reports of people being approved for mortgages in the 70s and the building society that granted them the mortgage being like, well, you've got it, but we can't give you the cash right now because we haven't got it. We're going to need to wait until people make more deposits. A far cry from the modern app-based instant decision, don't contact us because everything's contactless banking we have today. And all of that is because of Margaret Thatcher and her reforms. They called it the Big Bang. Maybe because of the impact it had, or maybe because out of nowhere, these finance companies got big. They got really big.
Recently, we've seen how one company can grow so large that its failure jeopardizes the entire financial system.
Today, this industry employs between 1 and 2 million people. It generated 173 billion for the UK economy in 2021.
Do you know how much that is?
So yeah, hate it or love it, the UK needs its finance sector. But there is a problem. In 2006, London was arguably the finance capital of the world. But that's no longer really the case. I mean, just in Europe alone, the French stock market is now bigger than the one in the UK, and Amsterdam sees higher trading volumes than London. I guess just another example of the UK inventing the rules of the modern game and then watching their neighbours get better at playing it. Unlike our exit from the World Cup, our fall from grace financially speaking has been somewhat self-inflicted. When we left the European Union, we made ourselves less competitive and just harder to deal with. And that has been reflected in the numbers. There's been a 19% decline in the amount of finance products we export as a country since we left the EU. That's according to a report produced by the House of Commons Library. So Jeremy Hunt sees these reforms as the answer, as a way to unlock investment and turbocharge growth across the UK. But his critics say that the Big Bang 2.0 will lead to a financial crisis 2.0. And these reforms are dangerous for consumers and just the stability of the UK economy. I'm going to give you both sides of it today so you can understand what is going on. But before we do that, let me tell you about today's video sponsor. The Daily Upside is a completely free, high-quality business newsletter that comes straight to your email inbox every day. What does that mean? Well, first of all, here's Cobweb. He's fresh from the groomers. Well, he went 2 days ago, so he's kind of got that sort of fresh look, like week-old haircut kind of fresh. But anyway, the people at the Daily Upside basically take all of the finance news in the world and condense it down into an email you can read in 5 minutes. I love it. I'll give you an example. Like this story here about how Bill Gates and Jeff Bezos have invested in a competitor to Neuralink, Elon Musk's company that wants to put chips in people's heads. On the basis my iPhones have always only ever lasted 2 years and any technology I've ever owned for that matter has ultimately died, I'm not going to be first in line to give one of those a try personally. But one thing that you should 100% try is the Daily Upside. So I've stuck a link in the description for you and I'll also pin one in the top comment so you can check it out. All you need to do is click it and put your email in and you're signed up. It's completely free as I said. And if you don't like it, you can always unsubscribe if you want. Can't they, Cobweb? Right mate, should we go give you a brush to say sorry for objectifying you again? We need to talk first of all about bankers' bonuses. Now, they're not part of these reforms, but they are the only lasting legacy of Liz Truss after she decided to go toe-to-toe with the lettuce and lost. The cap on bankers' bonuses came into force in 2013. It was an EU-led thing, so leaving the EU has allowed us to remove this cap, and they limit bankers' bonuses at 2 times the banker's salary unless approval comes first from shareholders in a bank. Now, the argument is that uncapping bonuses really is because finance talent is mobile. What I mean by that is, let's say I said to you, you can work in London, you can earn £500,000 a year, or you can go to New York and you can do the exact same job for 2 million. Where are you going? Many argue that the cap on bonuses makes the best talent leave, and ultimately, as these bankers are PAYE employees, the UK then loses out on that tax revenue. It's better for a banker to be earning millions in the UK paying taxes in the UK than to be earning millions in, say, Singapore and paying taxes over there. But the obvious concern is that uncapped bonuses drive risk-taking behaviour. Financial crisis in 07-08 was born out of greed. Uncapped bonuses breed uncapped greed. But the view here is that for the UK to compete, we need the best talent, and to attract that talent, we need to pay the same as everyone else does. Right, now let's get on to some of the juicy stuff. Starting with ring fencing regulations. Following on from the financial crisis and in an attempt to protect retail banking clients like me and you, rules were put into place that any large UK bank with more than 25 billion in deposits had to separate out their retail banking arm from their riskier investment banking operations. The government at the time called it their casino banking operations. I mean, wow, what a name. Now, these rules only actually came into force in 2019, and now they're already proposing that they're going to change them, changing that limit from 25 billion to 30 billion before a bank has to ring fence. There's always been criticism of these rules from the banking sector. They've been very expensive to enforce, as banks had to ring fence literally trillions in funds and split up sections of their businesses. But the main issue the finance sector had was that a lot of the institutions that went under in the financial crisis had very little investing exposure anyway. Northern Rock, as an example, ring fencing their investment casino arm would have done nothing to save them. It was reckless mortgage lending to retail customers that sank the business. The argument is these rules punish companies like Goldman Sachs who have to break apart certain parts of their business when they did not nearly collapse. They just profited heavily from everyone else's misery is what they did. I'm sorry. Be balanced, Damien. Be balanced. But I do think we should treat these changes with some healthy skepticism. A Freedom of Information request from FN showed that Goldman Sachs had 2 meetings with the panel who were considering reforming the ring fencing rules. JP Morgan also held meetings with them. I get when deciding on legislation, you will sit down with those who it impacts to get their thoughts, but ring fencing rules, from my perspective, seem to just clearly protect the end consumer, and investment banks who were at the centre of the 07-08 crash appear to have a clear agenda when it comes to raising the limit. JP Morgan owned Chase, and Goldman Sachs own a brand called Marcus, which have both been impacted by these rules, and they would benefit significantly from the limit being lifted. Sir Paul Tucker, former Deputy Governor of the Bank of England, said ring fencing helps protect citizens from banking Armageddon. Interestingly, these rules on ring fencing that we have currently were decided by the UK. We went above and beyond what the EU mandated. It isn't because we've left Europe that we can now suddenly change these rules. Other proposed reforms include VAT charges and short selling rules, which look set to be changed. So do rules on how much money insurance companies need to hold in reserve and where they can invest that money. Now, the VAT rules make it cheaper for fund managers to operate in the UK, less tax. The short selling will no doubt be more lenient than the rules in the EU, making it more attractive for hedge funds to be based here. And the proposals for insurance companies means that they can take the billions they have sat there in case people claim and invest it in things. This is called the Solvency II rules. The government hopes that this cash that's currently sat there on the balance sheets of these insurance companies will find its way into infrastructure and green energy projects, spurring on growth in the UK. Now, one thing that is clear when reviewing this is that when we say more competitive, what we mean is more attractive for finance companies to be here. And in the finance world, more attractive means less cost to operate and less rules. Another area that concerns me when it comes to this less rules thing is around PR, IIPS and the UCITS rules. These rules dictate how investment funds in the EU are managed and marketed to clients. Now, they're here for your protection. You'll often see the abbreviation UCITS at the end of a fund, and what this allows these funds to do is to be sold across Europe once they have this stamp. And investors know that they comply with stringent regulations and rules on safeguarding of assets. It also means that the funds have to come with a document that clearly states all of the fees and objectives of the fund. They look like this. Now, Jeremy Hunt wants the finance regulator, the FCA, to come up with their own rules and framework and leave these EU ones behind. Now, what concerns me about that is that under this mandate of making the UK more attractive and in line with the track record of making things easier for finance companies, do we think these new rules and frameworks will be as strict as the EU's or less? These are the rules on how much information an investment platform has to give you about the fund and investment products they're selling to you. Maybe they plan to streamline this and make the documents more approachable, I don't know. I saw them saying only 3% of investors actually read these documents. But the last thing we need is a step backwards in terms of transparency around fees. You might think I'm over-egging this, but when you read this point, it kind of hits home. We are issuing new remit letters to the PRA and FCA with clear targeted recommendations on growth and international competitiveness. That is Jeremy Hunt saying he wants the UK regulators of the finance industry to have a secondary objective, which is to focus on making sure the sector grows. If I was being cynical, I would say asking a regulator to focus on growth is like asking a referee to be impartial whilst making sure the reigning champions still win the game.
I think the referee's decision making throughout the game was really poor.
Too soon? What I mean is, growth at times can be in direct conflict of consumer best interests. For me, the regulator exists in their primary function to protect consumers, and that should not be muddied with a secondary goal of growth. All the more worrying when you realise we are ripping up the European standards for how funds are marketed and sold, and giving that power of creation of new rules to the regulator, who is also being asked to make sure the finance sector grows. Sir John Vickers, who chaired the Independent Commission on Banking that was set up after the financial crisis, wrote in the Financial Times this week that this objective was either pointless or dangerous. Now, within all of these documents, there are 30 tweaks and changes being proposed, and I've not covered all of them. I've missed out stuff like they're going to change their approach to ESG funds here in the UK. I've linked everything below for you, but the key question for me is all of this a good idea? I mean, I don't know. I'm not an expert on these things, but I will give you my 2p. As I look at these reforms and I see a step away from the rules that we inherited from the EU, I can't help but think that the power of the European Union was the ability to develop a product in one country or a service, get it signed off, and then sell that to the rest of Europe without restrictions. This equivalence was a major reason why the UK finance sector boomed, so much so that banks really pushed for passporting rights as part of the Brexit negotiations. They knew they needed those, as these passports would allow financial service businesses to sell their services to foreign markets without the need to complete additional admin and go through the individual checks for each country. We failed to secure those passporting rights, making it harder for banks to engage in Europe. Now, by ripping up the European rulebook and making up our own rules, surely we're taking a step further away from equivalence, making this process of interacting with the EU and all the trade that comes with it even harder. I recognise we need to do something to be more attractive, and deregulation of the finance space is a quick win and plays into our strengths. Like I said, I don't know, just me thinking out loud, but I find myself sitting here going, why now? I think people will look at these reforms and the way that they've been packaged and will kind of fall into three camps. Number one, people will see it as a genuine attempt to get the UK growing by making one of its key industries more competitive. Number two, with an election on the horizon, the Conservative government want to remind the finance sector that they are indeed useful in an attempt to stem an exodus to Labour when it comes to voting. The finance sector have already reacted well and put bottles to the news, votes in the bag. And speaking of votes, number three, again, with an election in mind, the government wished to find and advertise genuine benefits of Brexit, as both those in the for and against camps, rightfully so, sit here asking, what are these Brexit dividends you promised? As currently, blue passports, sovereignty and longer lines at airports just don't quite cut it. These reforms are being advertised as a genuine benefit of us leaving the EU. I just want to speak on that for a second, and I wish to say, I don't care who you voted for. This is a channel on money, not politics, but those worlds often collide. All I want is for politicians to be transparent and honest with the public so they can make informed decisions. But that appears to be impossible for some reason. So if I see them misleading people in the context of financial matters, I'm going to call it out. So on this idea that these are an example of a benefit of us leaving Europe. Now, it is true that when we were part of the EU, changes to finance legislation came a lot of the time from Brussels. And as a feature of them needing to apply to dozens of countries, they were often not bespoke to the UK's needs. So you could say, in an attempt to provide a one-size-fits-all approach to the EU, the UK was not served as well as it could be. But let's just point out, the UK finance sector became a global powerhouse while it was a member of the EU. So to say the EU held it back, when you consider it's gone backwards since we left the EU, is an interesting way to spin it, Jeremy. Whatever the root cause for the timing of these reforms and how they're being positioned, it's hard to ignore the uneasy feeling that mass deregulation of the finance sector evokes. At one point, I remember the government saying, post-financial crisis, that the UK wanted to move away from its dependency on the finance sector. This feels like an admission of failure on that point. Instead, we're going crawling back with a basket of goodies to incentivise them to stay. What could possibly go wrong?